Now, over the last two federal budgets, we've seen some announcements from the government suggesting some pretty significant changes are on their way in the context of Division 7A. We've finally now got a consultation paper from Treasury setting out a bit more detail about what those changes might look like. Now, it's important to remember that this is just a consultation paper at the moment. No draft legislation, no final legislation. So what finally gets passed might look quite different to what we see at the moment. But if you have any dealings with Division 7A, if you have clients who are private companies or have connections with private companies, it's important to start getting your head around where things look like they're going. Because the proposed start date for a lot of these changes is 1 July 19, and that's not very far away. Now let's have a look at some of the key things that are in that consultation paper and where Treasury looks to be heading at the moment. First thing is Division 7A loans. Under the current system, one way of preventing a deemed dividend from arising under Division 7A is to put in place a complying loan agreement. And you have two main options, a 7-year unsecured loan or a 25-year secured loan. Now what Treasury is suggesting is no longer having two options, basically having a single option for complying loan agreements, which would be a 10-year loan. A 10-year loan with interest and principal repayments being made over the life of that loan with reference to a specific interest rate. Now, what Treasury is suggesting is that existing complying Division 7A loan agreements will be transitioned into these new rules. So if you have an existing 7-year loan agreement in place, you'll move into the new system, but with the same end date of that loan agreement. It won't be extended. For those who have current 25-year loan agreements in place, they will also be transitioned into the new arrangements, but that will take place over a couple of years. But what it means is that for existing 25-year loan agreements, the actual loan term might end up being a fair bit shorter than what clients currently think they have. And that could have a pretty significant impact in terms of cash flow and how those repayments are going to be made. The other thing that Treasury is looking at doing is basically refreshing old pre-1997 loans. If they haven't already been forgiven or deemed to have been forgiven under the statute of limitations, then again, what Treasury is suggesting is those will now be brought back within the scope of Division 7A. We'll need to be very careful about those. Another significant change is Treasury is planning to scrap the concept of distributable surplus. So what that means is you'll no longer have to worry about doing complex calculations, but there is a much higher exposure, potential exposure to deemed dividends for clients. So at the moment, let's say a private company makes a loan to a shareholder of $100 and no loan agreement's put in place, the loan's not repaid. Well, what tends to happen there is we have an unfranked deemed dividend of $100. But the next step is we calculate distributable surplus of the company at the end of the year the loan was made. And the deemed dividend will be capped at the distributable surplus. So if the distributable surplus is nil, then the deemed dividend is nil, and you don't have to worry about paying tax if you're the shareholder who's received those funds. But what Treasury is planning to do is scrap that concept altogether. If a $100 loan is made to the shareholder and it's not put under a complying loan agreement, it's not repaid by the relevant deadline, there is a deemed unfranked dividend of $100 regardless of the balance sheet position of the company or its financial position. So very significant change, which really will have to be thought through quite carefully when it comes to loans being made by companies in the future. Now, one of the areas that came out of this year's budget was how we deal with unpaid present entitlements. And the government clearly wants to change the way that currently works. At the moment, there's a couple of different ways of dealing with unpaid present entitlements. Again, what Treasury is suggesting in this consultation paper is that an unpaid present entitlement will basically be treated just like a loan. So unlike the current state of play where we get this 1-year grace period and then we have to try and figure out what to do with it in terms of loan agreements or repayments, the proposed changes suggest that that unpaid present entitlement will need to be dealt with in the year following the year that the resolution or appointment of income arose. So you'll have a much shorter time frame to put in place that loan agreement or have that unpaid entitlement actually paid out. The Treasury is also suggesting that, again, a transitional period would apply so that existing UPEs that arose on or after 16 December 2009 will be brought into this system as well. So if they're not already under loan agreements, for example, you might have some sub-trust arrangements in place, it looks like those will need to be brought in within the scope of the Division 7A loan agreement rules. There's a bit of a question mark over pre-16 December 2009 UPEs. The consultation paper doesn't really go into that in any detail, but there is a question, as one of the discussion questions, as to whether people think that those older UPEs should be brought within the scope of the full Division 7A rules or not, or just left the way they are, which is potential exposure under subdivision EA. One of the other big changes that we potentially see is the way the amendment period rules work. Now, Division 7A amendment period rules, typically you get a 4-year amendment period. So even if you're subject to a 2-year amendment period, if something arises under Division 7A, that's normally extended to 4 years. But what Treasury is planning to do is extend that from 4 years up to 14 years. So that would be basically your 10-year maximum loan period plus 4 years. Again, that will mean that it's much harder to avoid Division 7A by saying, well, something happened 5 years ago, we've only just realised it now, but we're outside the amendment period, so we don't have to do anything about it. That 14-year amendment period would mean that prior year problems will probably need to be dealt with quite differently. Now, kind of consistent with that is also this potential change that rather than asking the Commissioner for his discretion to fix up Division 7A problems, you'll be able to do that on your own. So you identify a Division 7A problem that has existed in the past, and what Treasury is suggesting is that you can fix that up. You can make repayments, catch up payments, declare all the interest that should have accrued over that loan, and you don't have to go and ask the Commissioner for the permission to do that. You can basically self-assess that corrective mechanism and apply it yourself as long as you take appropriate steps to do so. So they're the main changes that are being suggested anyway in the consultation paper at this stage. There's a number of other minor changes as well, so we are likely to see a lot of changes come through when we finally get some legislation on this. Treasury presumably will be gathering submissions that are made on this, reviewing them, and then come up hopefully with some draft legislation at some point in the relatively near future, given we've only got 6, 7, 8 months before that proposed start date. We'll certainly keep you updated. It looks like there are some major changes coming in this area.